So I just posted a Fission portfolio in Excel on Tron class because there are so many videos. You can find any one you feel comfortable, okay, or you are interested in watching these videos, any one videos you like. Okay, so this is not limited to this video. Okay, and this is just for your attention here. And another one is about the uh, uh, production of USIN minus RF, SMB, and HML in Pharma French data library. So this is the paper or article about how to calculate these three factors, because originally I ask you to calculate, I ask you to use the data, okay, in the Pharma French database. Okay, we have these three factors. Of course, in the following, we also have more than three factors. For example, like we have two more factors like I and W and C and A. Okay. So this is quite interesting. So down below here, we have three factors data. We have five factors data. And then we also have portfolios formed on different metrics. Okay. All these data are just for your reference, because maybe in the future, when you try to analyze the portfolios you constructed, you may use this data to as a benchmark, so that you can compare your portfolio performance with these benchmark portfolios. Okay, so these data are quite useful. Okay, so this is just for your reference here. So let's come back to the single factor security market. Okay, so here we can describe this equation. So basically, this is just a linear regression, or we call this a one factor linear regression. Okay, so RI refers to individual stock returns. Okay, and we have expected return of RI plus beta I times M. Okay, so we have introduced an important factor or coefficient. We call this as a beta. Okay, so beta now becomes more and more important when we are talking about the index models or single factor models, because beta is the sensitivity to the market returns. So whenever we say, okay, uh, maybe this stock has higher beta. Higher beta means higher sensitivity to market returns. Okay, so if you check out this equation, that means if M, okay, so suppose now M is a market factor, or maybe you can treat it as a market abnormal returns. Okay, so that means if market return increased by 1%, okay, increased by 1%, that means this stock I or this asset I returns, okay, has a beta I returns. Okay, so this is so this beta I, put it another way, is it's a slope of this linear line, but also it's a sensitivity, okay, to measure how these stock returns will react to the 1% increase in market returns. Okay, so now we have a beta. Okay, so we can rewrite the regression. Okay, we can rewrite the linear regression here. So now we can derive a more formal formula. Okay, we call this as a return beta relationship. Okay. So now, from now on, and in the future, you probably will see more citations about the alpha and the beta. Okay, so alpha, what does alpha means? Alpha is that, okay, if market doesn't move, and this alpha is the expected return of the stock, okay, without considering the market changes. Okay, so that is the expected return of the individual stocks. But if you want to include the market impact, then you have to use beta. Okay, so now we have two parameters. One is alpha, the other is beta. But most of the time, we like to use beta to measure the risk of the individual stocks because it's a sensitivity to market returns. So if beta is higher, okay, if beta is higher, what does that mean? If beta is higher, so for example, stock A, beta is 0.5. For stock B, beta is 1.5. So what's the difference between stock A and stock B? So for example, if beta is 1.5, that means if market index create 1% return, that means stock B would create 1.5%, right? So stock B is more sensitive to the market returns. Or put in another way, stock B is more volatile than the market index. Or maybe you can treat beta as a measure for the for the asset risk. No problem. You can also explain beta, okay, in this way, okay, no problem. But we can just say, okay, beta is just sensitivity. So sometimes you will see a very interesting portfolio. Sometimes we call it as a, for example, if you Google for this, we have a very special a portfolio called beta neutral. Okay, so what is beta neutral portfolio? You can see beta neutral, that means you want to create a beta zero portfolio. Okay, we try to decrease the volatility of the portfolio to a minimum value. Okay, so ideally, if we can create a beta zero, that means this portfolio or this asset is beta neutral. Okay, so if you are interested in this portfolio, you can check out this information here. But what I like you to know is that based on this model, we can estimate individual stocks beta. But if you want to create a portfolio, maybe you can create a beta neutral portfolio. Okay, so that means in one way, this portfolio is not sensitive or will not be will not move, okay, by the market index. But on the other hand, this portfolio can also deliver positive returns. Okay, so that means this portfolio doesn't bear any risk related with the market. On the other hand, this portfolio can also deliver positive returns. So we call this as a beta neutral portfolio. But of course, beta neutral portfolio doesn't mean that this portfolio is the best, because maybe their expected returns is much, much lower than other portfolios. Okay, of course, you can try to combine high beta portfolios, or you can construct a portfolio with low beta portfolios. Okay, we sometimes high beta portfolios will outperform low beta portfolios. Sometimes high beta portfolios will underperform low beta portfolios. So this is not their performance are not very consistent across time. Okay, so you need to you also have to pay attention to the changes in the market. Okay, just like I mentioned in the first hour lecture, you have to watch closely about the fund flows across different markets. Okay, supposedly, okay, maybe 1 year ago, most of the investors were very interested in Bitcoin investors, so that it push up the price of Bitcoins. Okay, but now it's not so good. Okay, in Bitcoin investment. Okay, so you need to think about why people are losing interest in Bitcoin. Or put it another way, there's a strong power behind the Bitcoin market pushing up the price of Bitcoin, and they can also push down or sell the Bitcoin. Okay, there's some power behind the market, we don't know, but you have to watch this the price changes closely. Okay, so now it seems not so profitable in investing Bitcoin. So you need to think about, okay, where does the fund go? Where does this fund go? Go to which market? Okay, so you need to collect the data again. But the easiest way is to watch over the global markets. Okay, so every morning, just like I mentioned, every morning when you wake up, suppose you are a finance major student, you have to check out the global market index first. Okay, and then you also need to check out the forex exchange rate across different countries. Okay, to check out how these funds, because when we talk about the fund flows across countries, it will definitely affect the forex exchange rate. So you can also detect some changes. Okay, if you can detect some changes or some directions in forex exchange rate, you can also detect the direction of the fund flows. Okay, so this is also important. Okay, so let's come back to this model. Let me finish this real quick. In the following, we do have some formulas to help you to calculate the risk. Okay, the risk of the index. Basically, this is not that difficult, because now we are talking about the individual stocks. So what we are doing is to take the variance of this equation. So for example, what we are doing, just a minute, what we are doing is to take the variance, okay, variance on the left hand side. We can also take the variance on the right hand side, variance. Okay, so this is the variance statistically. Okay, I don't know if you can understand this, but statistically, we can take the variance on the left hand side and the right hand side. Suppose this is a random variable, so we can derive the result. Okay, so if you are not familiar with the process, you can read the textbook. Okay, but finally we can derive this result. So we can write the variance as a sigma I square. So this is the variance. So we define this as a total risk. Total risk. Okay, we define this as a total risk. And this is because this is a linear relationship. So we can also derive these results. Okay, beta square times sigma n square plus the residuals variance. Okay. Maybe this is a little bit complicated to you, but what I mean is that suppose now we have two random variables. Okay. I don't know. I'm assuming that you have learned statistics, but you can simplify this. Suppose we have, let me show you this. Suppose we have x equals a plus by. Okay, so this is a linear relationship. If we take the variance, if we try to calculate the variance of x, okay, so that means we will try to calculate the variance of a plus by, right? So you can derive the following formula. Okay, finally you will get these results. Okay, but what if we have two variables? Okay, so suppose we have x1 equals a 1 b1y, and the x2, okay, is equal to a2 plus b2y. Okay, so now we want to calculate the covariance of x1 and the x2. Okay, so you need to derive these results. So basically, you will need to calculate this a1 plus b1y and the a2 plus b2y. You need to derive the results. Okay, and finally you will get this output. You will get these results. So if you get calculate this, you will get, okay, finally the result will be b1 b2 b1 times b2 and times the variance of y. Okay, so this is the final results. Okay, so this is why we get this formula. But anyway, if you don't understand this, I suggest you to go back to your statistical. It's quite easy if you search on the lines, Google, if you Google this, okay, variance up to linear combination, whatever. Yeah, try to search this. Try to search this information, and you will get the some resources out there. Okay, this is not that difficult because there are so many materials out there, so I don't want to spend time here. You can search for this information by yourself. Okay, so let's come back to this. But anyway, we can calculate the covariance. Then of course we can also calculate the correlation. Okay, So this is for 2 assets. Okay, but what if we have more than 2 assets? Suppose we have 5 assets, we have 10 assets, we have 20 assets, or even more than 50 assets. Okay, so then this can help us in the following. Okay, but before we do it, before we calculate that, let's finish another part. Okay, because there's an element here. Okay, there's an element here. This is called sigma square EI. Okay, and for this part, we call this as a usually we call this as a residual returns. Okay, residual returns is something that can I explain by the market index. Okay, residual means something is left over. Okay, cannot be explained by the linear regression. Okay, so this is another issue, and we will study this issue maybe in the future. Okay, but now let's finish this. Okay, because this is a residual. Okay, so suppose we have a case like equally weighted portfolio. Okay, so in this case, finally the residual returns will become negligible if n gets larger. Okay, so which means as diversification increases, total variance will decrease. Okay, so you can see here, what I mean is, okay, sometimes I'll say, okay, sometimes this, so let's come back to this. Sometimes this turn, okay, sometimes this turn will be positive, sometimes will be negative, but finally it will cancel out each other. So finally this turn can be negligible. Okay, so all we need to do or pay attention to is to focus on this turn only. Okay. So this is why we have a equation explaining that, okay, if n gets large, this variance becomes negligible. Okay, so the total variance will become the systematic variance. Okay, so what is systematic variance? Remember, total risk can be decomposed into 2 parts. The first part is systematic risk. The second part is called the firm-specific risk. Okay, I also give this term a special name. I call this as a residual return. Okay, residual return. Officially in the textbook, we call this as a firm-specific risk. Okay. But if you don't understand this, don't worry, because this is about the firm-specific risk. And finally, if your portfolio becomes larger, then this risk will cancel out each other. So finally, you will see only the systematic risk. Okay, so we don't have this. We don't have this term anymore. Okay, so that's why you see here. Okay, as the number of assets in your portfolio increases, okay, the firm-specific risk will cancel out each other, and finally, you will see only the systematic risk is left. Okay, is there. So we call this as a systematic risk. Okay, so this part is about the systematic risk. So in other words, suppose you try to construct a portfolio with the same number of assets as the market index. That means your portfolio will behave completely like the market index. So that means the only risk you have is market risk. You don't have any firm specific risk. Okay. Or put it another way, you are just replicating your portfolio like market portfolio, market index. Okay, so this is about the variance of equally weighted portfolio. Okay, and then you can see this is another example about the Amazon. Okay, you can see the stock return of Amazon versus market index. Okay, so this is not that important. So what we are doing here is to use Amazon as a case, as an example, to try to describe how the Amazon returns are related with the market index. Okay, so finally, in this example, you can see we can derive the security characteristic line. Okay, we define this as a security characteristic line. So we have expected excess return, okay, alpha I, and we also have a beta I. Okay, so this is about the sensitivity of the security I return to changes the market return. Okay, and finally we also have EI. Okay. Okay, finally, we also have a EI. This is a zero mean, a firm specific return. Okay. Okay, so basically this is the, we define this as a security characteristic line or called SCL. Okay. But anyway, you still have to run the regression line to get the alpha and the beta, etc. So here is the output. Okay. Okay, now we have another problem. I think most of you have learned the linear regression, right? If you want to run the linear regression, you need to think about how many data should I include in the linear regression. Of course, if you are focusing on one stocks, okay, for example, like Amazon, this is the case of Amazon here, right? We can include a very long time series of data, okay, so that we can run the regression. But the problem is how long is the best? What's the period of time that should be best to estimate the beta? 6 months, 1 year, 2 year, 3 year, 5 year? Any idea? Okay, suppose some students prefer to use 6 months. Some students prefer to use 1 year. Some students prefer to use 5 year. Okay, so everyone will get different beta, right? If you run the regression, we'll get different beta. So the problem is the beta will change. Okay, will change. If you want to predict the beta will change. So it's really hard to predict. So that problem depends on what's the frequency of your market of your portfolio to rebalance. Okay, suppose in your portfolio you want to construct a high beta portfolio. So you need to check out the stocks in the market, and you need to run the regression, okay, based on 6 month data, and you can collect the stocks with higher beta, and then you can construct the portfolio. And if you want to rebalance your portfolio every month, so that means you probably need to use the monthly returns, okay, monthly returns to run your regression. Okay, so this involves many problems. Okay, depending on the frequency you want to use. So this is really confusing. Okay, so this is another topic we will study in the future. So but this is also important. But right now, we have a problem here, okay, because the beta tends to change, okay. So if you want to predict the beta, then there's some researchers, okay, suggestions from Rosenberg and Guy, and they found the following variables to help to predict beta. For example, variance of earnings, variance of cash flow, etc. Okay, so this is just for your reference. But in reality, if you want to calculate or estimate beta, the easiest way is to use the time series data, and then you can just fix the time period. For example, if you want to use 6 months, okay, that's fine. Then probably you want to make a timely changes in your asset allocation. Okay, but if you want to hold your asset for a very long time, maybe 1 year or 3 year time period of data is enough, and then you can use maybe 3 years, okay, or 5 years. That would be fine. Okay, so it's totally empirical. So this is a empirical issue here. Okay, other issues like we also have alpha. So what is alpha here? Let's go back to the equation here. So alpha refers to, okay, here is alpha. Alpha refers to expected excess return when the market excess return is 0. So that means if we don't consider the market changes, what this stock can deliver the most basic returns. Okay, so this is about alpha. So usually we also like to find the stocks that can deliver positive alpha. But this is not that easy here, okay? So we call this as you have to go through many analyses here, okay? So basically, just like I told you, you need to practice your investment skills through the fundamental analysis and technical analysis here. Okay, so that you can do this. Okay, so there are some directions just for your reference, but I don't think these are quite helpful. Okay, the only way to help you to uh, forecast a positive alpha is that you have to practice your investment. Okay, in so I just told you that you have to do some simulated trading. You have to practice this kind of trading many times so that you can define your alpha here. Okay, so let's have a conclusion about the portfolio construction and single index model here. Okay, so basically we have to find the risk premium. So suppose the market index is S&P 500, so you have to find the risk premium on S&P 500 standard portfolio, and then the second one standard deviation S&P 500 portfolio, and sets of estimates. So we have a beta coefficient, stock residual variance, and alpha values. Okay, so finally you can calculate the portfolio returns. Okay. Okay, so this may seem a little bit complicated to you, but let's just focus on the output here. Okay. Okay, so this P refers to portfolio. Okay, refers to portfolio. So now we have n+1 assets in our portfolio. So we have WI, okay, times alpha I. And then we also have a beta. So this is about the alpha I and the beta. Okay. And finally, you can also calculate the sigma P. Okay, you can also calculate sigma P. And finally, you can calculate the Sharpe ratio of the portfolio. Okay. So maybe this seems a little bit complicated. Maybe we can use different ways to explain this equation. Give me a minute. Yeah. So what I'm trying to do here is to use different representation. I like to use metrics, so I will use metrics to show you the calculation here. Okay. Okay, so I'll put this on the trunk class later, but let me explain to you what we are doing here. Because this slide is focused on the factor model, okay? Originally we will talk about the factor models, but basically when we talk about the factor models, Okay, there are three types of factor models here. Okay, the first one is macroeconomic factor models. The second one is fundamental factor models, and third is statistical factor models. But we won't go into the details of these factor models. Right now, all you have to learn is to focus on the macroeconomic factor models. So that's why we have index models, because we just consider the market as the market index as the macroeconomics indicators. Okay, so we include one factor, which is market index, as the macroeconomic indicator or macroeconomic factor. Okay, so we will discuss about the macroeconomic factor models. And for the second model, is about the fundamental factor models. Of course, some people like to use fundamental analysis to explain the stock return. For example, like cash flow, earnings per share, market capitalization, whatever. Okay, so you can also include these factors to explain the market return, to explain the stock returns. Okay, so this is second model. And the third model is about the statistical factor model, but this is more complicated. So we'll not discuss this model here. So let's just focus on the first one, okay? Macroeconomic factor models. But, you know, not just index models, we also have many indicators based on the macroeconomic. For example, like the growth of GMP, okay, economic growth rate, okay, and unemployment rate, inflation rate, okay, all these factors can be included in the model. Okay, so in the following, we will present a more general factor model in this way, okay? So for example, right now, we are not limited to just one factor. Okay, just give me one more minute, then we can take a break. This is a more general formula. So for example, here, this is factor number 1, this is factor number 2, this is factor number k. So we have k factors to explain the returns. Okay, but what you see, what you just saw from the index model is just this part. Okay, just this part. So this factor refers to market index returns. Okay. So now you can see we can have a more general formula for the factor models here. Okay, so let's take a break. We'll be back later. Okay. And we can have a roll call first. Okay. Let's have a roll call here. Okay, the roll call number is 5573. 5573. Okay.